is Wati Nuryanti. I will a presentation of financial statement. Financial statements are written records that convey the business activities and the financial performance of a company. Financial statements are often audited by government agencies, accountants, firms to ensure accuracy and for tax, financing or investing purpose. Financial statements include cash flow statement, balance sheet, and income statement. Cash flow statement. Cash flow is the lifeblood of a business which plays a vital role in economic life. The word fund is used in a narrower sense refers to cash. When cash is used as fund, the analysis relates to movement of cash. Cash flow refers to the actual movement of cash into and out of an organization. In other words, the movement of cash inclusive of inflow of cash and organization. It represents inflow of cash. Similarly, when the cash flows out of the business concern, it called as cash outflow. Use of cash flow statement. The statement is the most useful to the management to prepare dividend and retention policies. The first, it guides the management to evaluate the change in the cash position. Second, it presents input to the management about the performance of operational, financial, and investment activities for effective decision. 3. It helps to know how the movement of cash took place and the factors which cause the change in cash flows. It guides the management in order to take decisions about short-term obligation. And last, it also presents the detail about the source of cash and application of cash during the particular period. Difference between fund flow statement and cash flow statement. First, fund flow statement helps to measure the cost of change in working capital versus cash. Fund flow statement is prepared on the basis of fund of all financial research with cash flow. The 3 cash flow statement guides to the management for short-term financial planning while fund. And last, statement of change in working capital is required for the preparation of fund flow statement. Limitation of cash flow statement. Cash flow statement has limited scope as it compares with fund flow statement because it discloses inflow and outflows of cash alone. It does not reveal the overall financial position of the concern. 2. Cash flow statement cannot provide a comprehensive picture of a financial position because non-cash items of expense and incomes are excluded. 3. The balance as disclosed by the cash flow statement may not be treated as actual liquid position of a concern since it cannot be easily influenced by postponing purchase and other payment. The balance sheet. The balance sheet reports as a given point in the time research of a business or asset, its obligation or liabilities, and the residual ownership claims against its research or owner's equity. By analyzing the relationship among these items, investor, creditor, and other can assess a firm's liquidity, its ability to meet short-term obligations, and solvency, its due, its ability to pay all current and long-term debts as they come due. The balance sheet also shows the composition of assets and liabilities. The, rel- the relative proportion of debt and equity financing and how much of a firm's earnings have been retained in the business. Concept of balance sheet. Balance sheet in case of a non-trading concern is prepared in the usual way and contains particulars of all assets and liabilities of the concern or institution on the date on which it's prepared. The excess of assets over liabilities is termed as capital fund or general fund. The capital fund is made up of excess of income over expenditure and other income or surpluses which might have been capitalized by the institution from the to time. Assets. Assets are the resources that a business uses to operate its business, such as cash, inventories, land and building, and equipment. Essentially, assets are my item of value owned or controlled by the business that contribute toward generating revenue. Assets are categorized as either current or not non-current assets. Current assets are items of value that are expected to be consumed or converted into cash within the next 12 months. Examples include cash inventory that is turning over regularly and accounts receivable. Non-current assets are not expected to be consumed or converted into cash within the next 12 months. Examples include assets that the business would generally keep for more than 1 year, such as land and equipment, cars, and buildings. Liabilities. Liabilities are the financial obligations or debts of the business and include claims that creditors have on the business resources, such as account payable, bank overdraft, provision for employees' annual leave and long service leave, tax liabilities, and loans payable. Essentially, liabilities are amounts owed by the business to external parties. Liabilities are categorized as either current or non-current liabilities. Current liabilities are expected to be paid within the next 12 months and include creditors or account payable, inventory purchase, overdraft, short-term loans, and credit card and debts. Non-current liabilities are not expected to be settled within the 12 months and include mortgage on the building and equipment and long-term loans. Income statement. Balance sheet in case of non-trading concern is prepared in the usual way and contains particulars of all assets and liabilities of the concern or institution on the date on which it is prepared. The excess of assets over liabilities is termed as a capital fund or general fund. The capital fund is made up of excess of income over expenditure and other income or surplus which might have been careless by the institution from time to the time. Okay, thank you.